Welcome to Interactive Investor's Super 60 Fund Finder.
Growth fund managers scour the market for businesses that have the potential to grow faster than the market. Such companies tend to prioritise reinvesting profits back into the business as opposed to paying a dividend. Some fund managers focus their sights on smaller companies, which due to their size have greater growth potential than larger companies. One example in our Super 60 is the CFP SDL UK BUFFETTOLOGY Fund. As the name suggests, this fund aims to mimic the investment approach of legendary investor Warren Buffett. Among the top holding in the BUFFETTOLOGY Fund is Games Workshop, whose flagship brand is Warhammer. Other growth fund managers focus their sights on so-called quality growth businesses. These businesses tend to have big brands and captive audiences due to their market-leading products or services. Two examples in our Super 60 are the LF Lindsell Train UK Equity Fund and the FUNDSMITH Equity Fund. Among the top holdings in the Lindsell Train Fund are Unilever, one of which brands is Ben & Jerry's, and Diageo, the maker of Johnnie Walker Scotch, among other products. The FUNDSMITH Equity Fund, meanwhile, in its top 10 has PayPal, Microsoft and Facebook. Income fund managers, on the other hand, target businesses that pay a dividend. Such funds tend to focus their sights on undervalued companies. Two examples in our Super 60 are the City of London Investment Trust and the Murray International Investment Trust. Income investing is coined as a get-rich-slow strategy due to the powerful effect of compounding over the long term. Dividend reinvestment is where the vast majority of the stock market's returns come from.
The big question.
Some valid arguments still support the case for income investing. Purely from a portfolio construction point of view, income style delivers good diversification benefits, especially when blended with growth or other specialist strategies. Valuations for income stocks are also much more attractive now than at the beginning of 2020. When economic conditions improve and companies start paying dividends again, income investors should see an improvement in the performance of income funds. But one thing is for sure, income-generating funds have entered a new era. That's because the COVID-19 pandemic has led many companies to rebase their dividends to more sustainable levels. This makes it much more challenging for income fund managers, and some investors may no longer view income funds as a core holdings. For 2021, research has shown that UK dividends payments could increase only by enough to equal levels seen in 2012 and 2013. When considering income funds, it's important that UK investors do not just look at UK funds. While we have rich dividend heritage, having overseas income exposure gives investors significant diversification benefits. What's more, global equity income funds are flexible and not constrained by a single region. It's why they have performed much better than UK equity income funds in 2020, and why every income investor should consider them for their portfolio.